Hello everybody and welcome to another quick video, this time about valuation of a few stocks that I've selected for this spreadsheet. And these stocks are what I refer to the rule of 80 stocks. And let me tell you a little bit about the idea behind this video. So you may know VCs in the SaaS world, for SaaS businesses, software as a service businesses, they typically like to see long-term growth rate and profit margin rates. If you add both of them, they want to see them above 40. Now, the way I've done this in this video is I tried to do my own spin. And first of all, I thought, what if I doubled that? Because it's true that I concentrate on hyper growth, not just growth. So what if I did my rule of 80, so doubling what VCs typically look at when they look at a SaaS company, that's A, and then B, instead of using profit margin, because I have a lot of issues with any form of GAAP accounting or any form of like margin that's going to lead to big tax payments as opposed to simply cash flow margins. I much prefer cash flow margins. And what I view as more relevant for cash flow margins in general is EBITDA margin. So I use EBITDA as a proxy for cash flow. And when I take the margin rate of adjusted EBITDA, well, just EBITDA margin, I mean, most likely adjusted for all of these, but EBITDA margin, and I add that to the revenue growth, the question is, how many stocks can I find that add up to 80 or exceed 80? And in that case, it's kind of merging both philosophies. My main philosophy, which is investing for hypergrowth, which is looking at revenue growth as a proxy for product adoption, and as one of the main indicators of future return. That's what I look at. And then you have value investors who really look at cash flow. How much cash flow is the firm making? And this is what this spreadsheet is all about. And of course, the usual suspects coming up in this spreadsheet are HIMSS and StoneCo coming up in my spreadsheet. Why do I call them the usual suspects? Because not only are they two stocks that are growing very fast, analysts are predicting 59% growth next 12 months for HIMSS and 45% for StoneCo, but they're also companies that have outstanding EBITDA margin. Now for StoneCo, I know this sounds crazy, 60%, but when I look at the current EBITDA margin and when I look at what analysts predicted to be next year, I do get at 60% for StoneCo. We'll see in a second that is because it's in the payment space. Payment companies are so profitable. Payment platforms are so profitable. It's not even funny. And then HIMSS, for HIMSS here, I used the between 20 and 30% guidance that they gave us for 2025, which I think they will reach in 2024. And I took it right in the middle. I said it was 25%. So if I look at either HIMSS or StoneCo and I add up the future revenue growth, in addition to how much they're going to be making in form of cash flow in the form of EBITDA margin, I get at 84 and 105 if I add both of them. So I'm well above the rule of 80. And keep in mind, this is in percent. This is not supposed to be in percent, right? This is just supposed to be a number. Doesn't make much sense to add them up, but my spreadsheet was like that. So anyways, just think of it as a number. So I'm above the rule of 80 for HIMSS and StoneCo. Great cash flows and great growth. Now, what other companies can I find that fit the rule of 80? Well, interestingly, a lot of payment companies fit that rule of 80 pretty well. So we've just discussed StoneCo. Another stock that I've covered multiple times on the channel, come under attack by short sellers so many times, but it's Dlocal. Dlocal is actually a pretty inexpensive stock. Not as inexpensive as HIMSS or StoneCo, but pretty inexpensive. And it is still exhibiting 54% next 12-month revenue growth, as well as a 29% adjusted EBITDA margin. So we're at 83%, we're at more. But look, more than 80. But look also at what happens when you look at a company like Visa, for example, which is a company I would not invest in. I would dismiss that company because of the 11% projected revenue growth. This is a company that's mostly growing at the pace of the economy and that may see disruption in the future. But when you look at the adjusted EBITDA margin of Visa, it is scary high. I mean, 70% EBITDA margin for Visa. And look at their gross margin. Their gross margin is 98%. such a profitable company trades very expensive as far as my EV, enterprise value over gross profit over revenue growth metric, which is my measure of a value of a growth stock, right? This measure asks how much am I paying for each percentage point of future revenue growth, right? Visa is the most expensive stock in this spreadsheet, but it is also the most profitable, even though it has next to no growth at 11%. You're growing less fast than the denominator. All right, and by the way, HIMS and StoneCo both show great rule of 80, and they both show a very cheap stock, very cheap valuation. The usual cheap stock in my spreadsheet is like a 20 or 30, but like this is a 0.03 and a 0.04, so such inexpensive companies. And if I move on to another stock, which I think that might surprise you, so of course Nvidia as well as Tesla, if you use the analyst number for both Nvidia and Tesla. I'll just comment on Nvidia for now. If you use the analyst numbers, some people think that 44% next year revenue growth for Nvidia is way too conservative. You have analysts out there who think they will double their revenue growth. But if you put that aside and if you just look at the 44% revenue growth for Nvidia and you add their current EBITDA margin of 38%, you're at 82%. So Nvidia is a rule of 80 stock, right? Twice the rule of 40. That's pretty impressive. And the market is pricing in a lot of forward growth, but the market is seeing this as a premium player. It's granting a premium valuation to Nvidia, but perhaps rightfully so if they double the number of GPUs that they sell. Tesla right now is not at the rule of 80, although as far as the price for that future growth, what you're paying at a pretty similar price to Nvidia. Keep in mind that there's a lot of debate with Tesla, with what the future revenue growth is going to be to Tesla. A lot of analysts, a lot of people out there are saying, in 2024, the revenue growth might stall. And that's why you have the average analysts who are saying we're going to have 31% of revenue growth in 2024. Catastrophe, end of the world, sell the stock, 30-ish% revenue growth. But if you've been following the channel for a while, my long-term outlook for a stock like Tesla in revenue growth is 50%. I think that's closely going to track their delivery outlook for cars that they gave, which is 50% every year until 2030. I think that's closely going to track it. Of course, the price of the vehicles will go down over time, but the software attach rates will go up and energy will go up. So to me, 50% is still a great number to use. So if I were to use 50% here, and right now, of course, the EBITDA margin for Tesla is under pressure as they are doing everything to push volume through and really take market share, which arguably is what a lot of companies should be doing right now, and I think they do a good job with that. But as they implement all of these factory changes, I don't know if you've been following Tesla, but we know some of the improvements they made in Shanghai are pretty interesting. Some manufacturing processes costs being cut in half compared to what they were. So is the EBITDA margin going to trend towards a 30% EBITDA margin for Tesla? I have no doubt these margins will go up as this company becomes more and more of a software company and implements more and more software. And of course, if you, over the long term, estimate 50% and 30%, which I have no issue doing for Tesla, you get at a stock that would be at an 80% or at a rule of 80. Even though right now, using the right now numbers from analysts, it's not at a rule of 80 yet. But that's okay, because we have some final stocks that are at the rule of 80 to briefly discuss, which are CELH and TransMedics TMDX. So CELH, you may know, CELH is the beverage company. People compare this company to the new Monster or the next Monster, right? They sell an energy drink in the US that's taking the US by storm. It's all over the US. You can see it everywhere. They still have lots of avenue of growth for Europe and within the US, taking market share from companies like Red Bull or companies like Monster. Anyways, enough about the business model. What's very fascinating with CELH is that their growth grants them almost single-handedly that rule of 80 because they're growing at 78%. Now they also happen to be EBITDA margin positive at 60% EBITDA margin. So you're at a 94%, which is outstanding, right? So that fits that rule of 80 theme of the video. And incidentally, any stock that you're gonna find who does not have a negative EBITDA margin, and you gotta be careful with that because some stocks have negative EBITDA margins, which means that, you know, the more they grow, the more money they lose. So you need to be careful with that. You know, you at least want it to be neutral, but as long as you have it slightly positive to neutral, then the revenue growth becomes the rule of 80, right? And if you have 80% revenue growth, you're at your rule of 80. And then I picked the stock TransMedics because their EBITDA margin is roughly flat, which means that it doesn't penalize them. They're not penalized by this. And in that case, I would just take 114% predicted forward growth and take the 114 and put it right here on my rule of 80 column. So that would be 114% rule of 80. So the conclusion of this video is that there are stocks out there that satisfy the needs of both value investors who want to see cash flow and more cash flow every year, and the needs of growth investors. And, you know, that's why I own most of the stocks presented in this spreadsheet, right? Aside from Visa and unfortunately Nvidia that I've sold, I own either tiny, either larger positions of all of the stocks in the spreadsheet, Tesla being the biggest position at about 40% of the portfolio. But HIMS and Stone are getting up there. You know, I've been adding to HIMS after earnings, outstanding earnings, and, you know, I'm adding to StoneCo right now because, you know, I'm hoping for the best for their earnings. I mean, hope is not a strategy, but I think StoneCo is highly undervalued, and every quarter that goes by, that revenue growth, right, keeps coming, right? And that enterprise value over revenue keeps decreasing and decreasing and decreasing until the market re-rates the stock, right? Until the market re-rates the stock. Keep in mind, while many of these companies may not be at all-time lows in terms of stock price, they are actually, and this is true for the case of HIMS, for example, but many others here, they are actually at all-time lows when you look at enterprise value over sales. When you look at this ratio, they are at all-time lows. So you're buying ever more sales for an ever cheaper price in a way. So I expect a valuation reset for so many of these companies. And I look forward to 2024 and the end of 2023. I think we're going to have some amazing moves. Anyways, this was not investment advice. This was just entertainment, hoping you were entertained. I appreciate your likes. I appreciate you subscribing to my channel. Thank you so much for watching and have a wonderful day.